Hi, I'm Mal from the Money Study, bringing you another episode of our Take 10 challenge, and we're up to number 79, reverse mortgages. Um, there's my disclaimer, facts, figures, information only. This is not advice in today's video. Now, reverse mortgages. We haven't talked about real first normal mortgages yet, but we will certainly will. But just while we've been covering across this sort of retirement aspect over the last few days or so, I think it's not a bad time to sort of mention what the story is with reverse mortgages. A reverse mortgage effectively allows you to borrow money using the equity of your house, but effectively you don't have to pay it back while you're still alive. So this can be useful for people who indeed are asset rich. So they've got a house they're living in. The house might be worth, 800,000 or 2 mil, but they don't have a lot of cash flow. They don't have not much super. Might be even living on the age pension. The house is not an asset for age pension, and so forth. But they've just got not enough income to live on, and so effectively they're going to a bank to get a reverse mortgage where the bank says, okay, we'll lend you the money, we'll get the money back eventually when you die and the house is sold. That's the theory in the broad sort of concept there. Now, it obviously came in for a fair bit of flack. These things were very, very popular over a decade ago, and they lost popularity. There was a lot of bad press about them. And dare I say, a lot of it was coming from the next generation where they could sort of see their inheritances sort of starting to disappear. Look, yeah, that's an issue, but really you've got to look at your retirement as being the number one thing. There's not much point you scrimping and saving all your money, but then not having enough money to live on in retirement, having a beautiful house, but then I say eating baked beans. So literally, these things can certainly be useful, but of course, like all these things, there are downsides as well. There is a limit to what you can borrow, and if you're 60, generally speaking, there's different companies that provide these things. The most you could probably borrow at 60 would only be about 15 to 20% of the value of the home. So if you had $1 million house, you might be able to borrow up to say 200,000 or something like that. There's a bit of a guide there. You could add an extra 1% for every year over 60. So at 65, you might be able to borrow between 20 to 25%, and so it goes on. Most of these lenders also have a minimum, which is usually around about $10,000 is the most that you could borrow. So they could be useful just for a short, a small loan of 20 grand to go on holiday in your retirement, and you think, oh, I'd love to go on holiday, can't really afford it. Where's the money going to come from? A small reverse mortgage under that sort of circumstances, yeah, not really a major problem. Depending on your age, of course, you can take the amount you borrow either as a regular income stream, so it'll just give you more money to add to your perhaps your age pension or your superannuation pension. You can have it paid to you regularly, or just as a lump of money sitting there waiting for you to take if you needed it, or just as a lump of money to go out and buy yourself a new car or go on the holiday or whatever, or basically a combination of the above. So they can be pretty flexible, and it does vary between lenders as to what they will do and how they will do it. So just make sure you read the sort of fine print. But as I said, you can stay in your home and you don't have to make repayments while you're living there. So if you do move and the loan's not moved to the new house and so forth, then yes, it probably generally speaking, you'd have to pay the debt back at the time you did move. But while you're in the house, not a problem at all. No repayments have to be made. But if you sell it, yep, then something's got to be done. Now, of course, the banks aren't just going to give you this money, that's for sure. They're going to charge an interest. And of course, because it's a reverse mortgage, where normally with a normal mortgage, as time goes on, you're paying the debt down, the interest payments are getting smaller. With a reverse mortgage, because the debt is getting bigger, you can imagine if you're getting paid every fortnight, the amount of money they're lending you is getting bigger and bigger and bigger, hence the interest is getting bigger and bigger and bigger. So the longer you got this reverse mortgage going for you, the bigger the interest is going to be. So now this can be obviously a bit problematic if we don't know, how long we're going to be living for and what's our scenario in the future. Now you repay the loan in full, including all the interest and the fees, which cost us fees, when you sell or move out of the home. Now you can indeed make voluntary repayments. So just like with a normal loan, if you've got a bit of a windfall from somewhere, you could pay the loan down to reduce the debt for later on. It could be a case that you had another asset that you were sort of didn't want to sell because it wasn't the right time. You take out the reverse mortgage to get you through a spot, then you sell the asset that you knew you were going to sell, and then repay the loan back. So it can be quite a flexible tool in that regard for certain circumstances. If it's not just purely the fact you might not have enough, cash because you're broke, could be cash because you just got your investments tied up in something else. With these loans now, there's a lot more restrictions and protections on them than there used to be 10 years ago because of the flack that was sort of thrown at them. So a lot of these things, the problems that people were raising with them have been sort of fixed one by one. And one of the main ones there was to protect the value of the equity from being eroded by the loan, meaning that the loan can't get bigger than the value of the house, so there will always be something effectively left over. So if the house was sold, yep, they could pay the loan out, but there would still be something effectively left. You can't have the loan to getting bigger than what the house value would be worth, and the lender builds in sort of restrictions as to obviously what you could borrow, and valuations are done obviously to ensure that they're pretty well protected there. It could be a case that obviously you need to ensure that eventually you're going to need some money to go and move into aged care. So we don't want the loan to get so big that when we sell the house we've got nothing, and then it sort of affects our ability to get into some sort of aged care arrangement. As we sort of suggested, this debt's going to get bigger and bigger, and can get big very quickly because it's compounding. The interest rates generally higher because obviously the problem for the bank is they're not really going to get any repayments on this. Could be for 20 years. So they'll lend you money where they're not going to see any benefit in the short term. So you can imagine that if that's the scenario, the bank certainly, when they get their money, they want to pay up for the fact that they weren't getting this money in the interim. So interest rates generally higher than a normal home loan. Now, of course, this is where you've really got to be careful in this regards that your home is not an asset. Your home is not an asset for Centrelink purposes. But if you get money from a reverse mortgage, you've now got $300,000 just dropped into your bank account from the reverse mortgage from the value of your house. Then all of a sudden you've got $300,000 an asset, which could indeed impact on your age pension. Or if you're getting paid fortnightly, it's going to impact on your age pension. So we've got to make sure that what we're doing here is not just going to get more money from the reverse mortgage to see us lose money from our age pension, and the whole thing just becomes a total waste of time. So you really need to do your numbers on that, get someone to run through it to find out what the end scenario would be. We've already talked about this business with aged care, but it could be any other future need, healthcare costs or something, just making sure that you've got enough money, or if you do indeed want to leave money for your children, to ensure there's money left over to do that. Now, if you're the sole owner of the property, but someone lives with you, now that person may not be able to stay there when you die. Now, that's not always the case, and that's just in some cases, and depends again on the lender and so forth. But obviously, if you wouldn't want to be the case you own the house, but you've got a partner, you die, and then of course they've got to move somewhere else. So just make sure how this is really going to affect the estate and the people that you're living with and the current family situation there. And if you do get one of these loans with a fixed interest rate, you can imagine that there'd be good times to lock it in and obviously bad times to lock it in. And then it literally comes down to, if you want to break that agreement because of the high interest rate, there can be certainly some expensive costs to be doing that. So quite a few sort of negatives there, but don't be completely sort of, weighed by the negatives if you think that the actual idea of it could indeed be could be useful for you. I really do believe that there are, for some circumstances, I say generally speaking, certainly if it's a shorter term need, where we see that there's going to be money coming from somewhere, but we just don't have the cash flow in the interim, could be a good way to be able to tackle that. But make sure you understand what the costs are in, getting out, and breaking it and so forth. If it is indeed planning it to do it on a shorter term basis. Happy to have a chat about these things as usual, and look forward to you joining us on another future session.